Okay, good morning, everyone, and welcome to this morning's event. You're all very welcome. For anybody who is joining us for the first time, my name is Mark Tobin. I'm the founder of Coffee Microcaps, and you're welcome to our Appendix 4C results wrap. We've got four great companies presenting this morning. I'm just going to quickly run through some intro slides here, and then we're going to get straight into it with our first presenter. First up, I'd like to thank RAS Research as a Service, our sponsor here at Coffee Microcaps for all our virtual events. And just an FYI, I will be sharing research produced by RAS on the four companies presenting today. So please watch out for me loading that into the chat as we move along through the presenters. Quick compliance and disclaimer slide, and welcome to anybody from ASIC who's joining us this morning. For anybody who is joining us for the first time, the companies we tend to have presenting on here, capped under 300 million. That's our definition of a microcap here, Coffee Microcaps, generally in revenue, cash flow break even or heading in that direction, or indeed, as you'll see from some of the companies this morning, actually profitable. So we tend to not have companies from the resources and biotech sectors, what I like to call industrial microcaps. Structure this morning's event, we're going to have four companies presenting. Each company is going to get 30 minutes thereabouts, 20 minutes for Prezzo and 10 minutes of Q&A. If you do have any questions, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel on Tuesday. You can follow us pretty much on all the socials. Twitter is probably our main one. As I said, YouTube for the recording of this event and indeed all our previous events. We've got well over 100 events incorporating probably 250 ASX microcap companies. So if you're looking for some more content, please feel free to check out the channel. And I also do a monthly newsletter that will also be coming out probably mid next week. Just to run through the running order, we've got Trent Lund from Wrkr coming back to give us an update. Leading off the betting, then we'll have another returning presenter. Should be no stranger to anybody at Coffee Microcaps events, Martin Filz from Pureprofile. Then presenter from our Sydney conference, Michael Ivanchenko from Kinatico will be joining us. And finally, another returning presenter. We'll be heading out to WA to hear from Ian Olson at Pointerra. But that's enough from me. So I'm going to stop sharing my screen and hand you straight over to Trent Lund from Wrkr. Trent, if you want to start sharing your deck, I will let you know when I can see it coming through. Yeah, I can see the cover slide of your deck now.
There you go.
So you can take it away when you're ready.
Wonderful. Thanks very much, Mark. And again, pleasure to be here on your channel. Thanks everyone for joining. Look, I'll kick off with just a little background on Wrkr and where we play, and then we can get into the meat of it for those who know our business, and hopefully plenty of time for Q&A. Obviously, there's all of this research itself, but we are Sydney based, but our teams are based in Sydney and Melbourne, about 42 people, and we're 100% onshore. So Australian based software engineering company, sitting around the 40 mil market cap, and sitting in the direction towards now EBITDA positive is where our current forecast direction is. Let me jump in and just a couple of quick facts. This helps people understand who we are and how we're building as a business. But product mix for our business is actually, we have a good balance. They're connected products. So many of our customers take multiple of our products, but the onboarding compliance moments for new hires, through to pay and super processing, through to license credential checks, but most importantly, all of the compliance and lodgement between the ATO behind the scenes. That's the mix. We are predominantly SaaS and user transactions, small amount of float, interest income, and license. We do have services revenue in our business, but those services revenues are predominantly pre-implementation fees before large organizations go on to SaaS licenses per user. So today we sit around 5.2 million of our revenue, of our around 9.5 million revenue. We sit around 5.2 as our ARR, so what I like to call the good revenue. We run at an ARPU, average revenue per user, of around $7. And of our direct users that fit under that profile, today we already serve about 500,000 users. Although our software actually extends broadly in the market, we touch about 2.9 million Australians, 2.9 million TFNs, tax file numbers. So, we're certainly on the grow. I'll leave you to do your own maths, but our entire focus in the business is growing those direct users through channel to operate at that 7 to 8. We're trading at $8 ARPU, but we have a target benchmark of 7 and growing. So that's really the key background, the way to look at our business. Let me start with, so what is our business and what do we do? Well, the main problem is, well, for Australia, and I think every one of you has either worked in the role or you lead a company and you've had to deal with it, but the compliance complexity for both hiring an employee and paying an employee is just going up and up and up in this country. Has been doing so for years, and that is compounded by, obviously, we're then also transiting an enormous amount of PII or sensitive personal data and potentially putting employees at risk. So that is putting pressure on the system for the requirements of quality software to underpin this. So specifically for hiring an employee, identifying them correctly, making sure they've got a right to work and what the constraints are, TFN checks, tax declarations, and the most complex actually is the super choice moment. I'm going to talk a bit about that today because that is the bread and butter of our business. Just to give you a little insight, by law, every company in Australia is obligated when they hire a new employee is to staple them, so give them the opportunity to select their existing super fund or make a choice. And if they don't choose either of those, they can select a default, and you're also obligated to provide a default. The management of that process has to be recorded, has to be clear, and today it's done by one click into the ATO. It's not one click, it's log in through your as an RM, do a one at a time TFND search after you've done your Gov ID, and that sounds great if you only employ one person a year. It's pretty tough if you're a major supermarket putting on 28,000 people. So that's on the hiring side. The complexity is actually quite high, and you require the technology behind it isn't just great digital tech. It needs to be integrated into the system, which Wrkr does. On the right-hand side, which is paying, pay processing, paying disbursements, paying super contributions and moving that money and the information along the SuperStream network, single touch payroll reporting, and then the reconciliation. To enable that, a business needs to have a particular AFSL, which is the AFSL for non-cash payments, and be a GNGB gateway or clearinghouse, of which there are only 9 in this country. And Wrkr is one of those, and our licenses and software underpins another of those in the country. So two of the 9. So core for us, Wrkr sits where, the way I describe it is, it's an iceberg, and we sit below that iceberg and move the most complex of those transactions. They're very high volume, high complexity, but it creates for a very large moat around our business. So who needs these problems solved? Well, the good news for us as a company, the pyramid really represents who has the largest proportion to solve that problem. But Superfunds today move the most amount of super contributions on behalf of employers, and I'll talk a little bit about that in today's presentation. They are our largest customer group. In the market, payroll providers outsource this work, particularly around the super contributions movement. Small business owners, HR system providers, all the way through to up to employers who choose to do it directly. So it's a relatively unknown problem unless you're sitting in as a CFO or in payroll or HR, or you've had a tap on the shoulder for failing to meet your obligations. The fines are onerous. It's expensive and reputationally difficult. So people look to strategic partners such as Wrkr. So that's the background of who we are. Couple of little things to share. The way we operate is we leverage. The key to this is a mobile experience for the employer, so the employer can participate in their own data, an employee, in the brand of the employer, but the contributions being passed and processed and paid for at a contribution level by the Superfunds. So it's a complex ecosystem that we've developed our technology to navigate. So effectively, we sell to one large channel client, a super fund, but that actually enables us to reach a large amount of employers. If I take a typical industry fund is touching and servicing up to 100,000 employers, up to 1 to 2 million employees. So it's a very fast pace to market once you've integrated and built the solution in. Obviously, where we go direct, though, the key for us is bringing this together and partners, other players, and their compliance moments into a one-stop shop for organizations. So that's the context of our business. I probably want to, before I jump into the detail here, so I give you that as context because not many people even realize this is a large challenge in the market. We see the challenges in bite sizes. So Wrkr really is on a mission. We're fairly single-minded about it, and that is to transform the employer to employee compliance experience. Today it's poor. It's either done on paper, it's done through multiple providers, security standards are suboptimal, and people are struggling with the trade-off between a good experience to onboard an employee and meeting the obligations. So you can't cut corners. So how do you achieve both? That is the mission for our business, and that is really what's been the backbone of our success. That transformation, we are starting with the transformation of the superannuation industry. These are the largest organisations in Australia from a singular reach to members, and most certainly very influential in this underpinning of standards. So to achieve that, we've worked very hard to partner with, they were known as the Link Group, now MUFG Retirement Solutions. So apologies, I'll alternate. I still haven't quite got it in my mind from Link to MUFG. But as an organisation, we have partnered with them to take our solution and technology, provide it under a SaaS license to their clients. Now, we're very fortunate in two things. One, it's been a substantive co-investment between both MUFG and Wrkr to both develop additional features unique for the industry fund landscape, to prepare the platform to really deal with two new changes one that's already arrived in stapling that I'll touch on, and that I mentioned a little bit before, and payday super that I'll touch on at the end in 2026. So we've invested heavily. We've integrated the platform into their administration platforms, contact center and support, infrastructure, processes, and talent, which has now positioned us to roll this solution out to each fund that wishes to adopt it in preparation for payday super. That is a major effort, and to be honest, for a small business, we've grown at a fantastic rate, but we've been bootstrapped because we've invested every dollar into driving out to this position. And so what that really means is we build a core platform that as I've just described, but the why is fairly key. When I look at MUFG, they really represent some of Australia's largest super funds, some of the most prominent brands that have some of the best reach into the employer network. So they provide and process contributions today, of which that is our target market in step one, is to take over the processing of those contributions and onboarding of members. And their current client list is Australian Super, Rest, Host Plus, CBUS, Hester, and a variety of others, some 7 million contributing members. So that is our pathway to the 14.5 million full-time employees in Australia, of which about 19.4 million jobs. So some people are working harder than others with multiple jobs. But that target market, this is our trajectory and why we've been investing, because our target is to reach half of the working population of Australia. That's where we're going to continue pushing this business towards. And we're very proud of what we built underneath to make that a possibility for the business and our shareholders. So the MUFG contract is really our number one focus right now in delivering this value and technology. So that's really the background, the core of the business. And I talk about super because, well, one, it's ubiquitous. The government have mandated it across Australia. It continues to grow as it ratchets up to 12%. But it's also a very complex service to provide, with many players having to participate. So having us sitting underneath and managing the movement of money, the movement of messages, the movement of data and information, and the movement of members into that system, having one capable supplier able to deliver that across a large volume, obviously will open up an enormous amount of possibilities beyond the super for our business. So that is the core. So where are we headed? It's probably worth touching on our financial highlights. So while bootstrapping our way, we've just come out of our 4Cs recently. Some of you may have sat in on the quarterly, so apologies. This may not be news for you, but we're sitting on operating cash flows performance in that last quarter, which were significantly up. So a positive 340K, up 190% on when compared to the year before. And that's true of nearly all of our metrics. We have been up quarter on quarter, year on year. This is that positive net cash flow really achieved for the first time in the company's history. Wrkr's only been the new brand over the last 2 and a bit years, post a merger 3.5 years ago. Nearly 4 years ago now. I'm getting old. But in the entire history of the company, this is the first positive cash flow. Partly driven a real commitment. We continue to drive costs down. You'll see the cost to income ratio still improved, even though we've been very cautious with cash. Cash receipts, 9.1 million, up 46%. And that trend is really a growth in our SaaS underpinnings, very high retention. We sit on our major contracts and a 100% retention. Our largest single platform contract we just recently announced, that's with Australian Retirement Trust Precision, their administration business inside for Beam. That software license we recontracted for a further 2 years, so extending on with a 25% uplift. So across the board, we're pretty proud of the fundamentals. The historical financial results, I think some of you may have seen this before, but the trend line is fairly clear. We've been growing, at around the 40% or higher. That's easy to say when you're off a low base. We intend to continue in that direction. The next 12 months is a large opportunity in front of us. So we will likely drive far more investment into implementation to bring a larger volume of SaaS revenues forward. Just to touch, I'll touch on that when I talk about Payday Super. But as you can see, the trend lines continue to grow. that's a projection on FY24, but we're fairly comfortable with where we're landing there. So, like, I think some of these we have targeted a positive EBITDA for 2025. In our view, we've worked very hard to get close to that. We'll wait and let the auditors do their work for FY24. There's the big key change on the financial outlook and the regulatory tailwinds is really payday super. So to date, it suggests that July of 26 is the start of payday super. What does that mean? It's a small, one would think a small change. It is an enormous system change for the super landscape. And that is the government mandating for all companies superannuation to not be paid quarterly or monthly if you're over 3,000 employees. It must be paid in sync with your pay. So when wages are paid, super gets paid. And this is because there's a little over 2 billion in unpaid super hanging out in the ether. The government is the funder of last resort on underpaid super. So they have a mission at Treasury to bring this system and remove fraud and risk for Australians. But what does that mean? Well, that means for any company that is currently processing their super contributions, they need a significant uplift. And that's really the opening door for our organisation and what we're focused on over the next 12 months. So 24 months out from 23 months now, as at today, 23 months out for large super funds, HRM and payroll systems to really upgrade where they're at to be able to enable that payday super. And it's not just the processing of cash, it's the ability to remove the errors within a week if you're paid weekly rather than having a quarter. And that means the shift towards a different technology mindset. So that's really the core of what's going on in our business. But I did rush through that because it's recorded and you can go back, but I'd rather get into some Q&A and talk about, I'll leave this on the screen, but maybe Mark, good opportunity. We can just jump in.
Yeah, maybe if you just want to tab to the next slide, Trent, and we leave up that investor hub details. Yeah, there we go. Yeah, just a question from me in terms of, you talked about the two sides of the business, new employees joining a business versus, the ongoing paying of somebody every month. Is there a major kind of profit margin difference between them? Are you like agnostic? Are you, is it better for you to be taking on a client that, is hiring lots of people and growing, their business as opposed to maybe, somebody like Coles who, they're hiring, people are leaving, but, essentially it's the same. I don't know how many people Coles have, like 20,000 people, every month that are getting processed. Maybe just talk to the two sides and how it affects margins.
Yeah, we tend to, with the big contracts, build it into a flat SaaS fee. So we like volume, there's no doubt. However, where we sell direct into the market, so employers buy directly off us, the onboarding is far more profitable. And I mean, to give an example, it's the combined compliance moment. So we are, in the complexity of navigating, say, the chemist environment. It's not just onboarding an individual, it's APRA medical checks, it's we process and they select, their contract is agreed to, and the contract policy elements help define the actual role, which then feeds into payroll for accurate pay. So that's in that area, it's a much higher risk for an organisation, so our return is higher. But where we go to market with the super funds, we build it into the flat price. So, we love a Coles coming on board. Coles would benefit greatly because they have a higher turnover rate, for sure. What's unique though is probably different to other industries. We like the industry funds because they are the highest moving employees, and although probably on average the lowest paid, because it's a lot of first-time employees, first-time jobs. For us, the transaction income is the same, whether I'm doing it for the CEO of a multinational or somebody who's having their first full-time job packing shelves in Woolworths. It makes the same for me. In fact, it's better because they'll be paid fortnightly. So that's 26 transactions versus 12 monthly transactions.
Yeah.
So yeah, if that helps.
And that helps. And then, yeah, just on the industry funds, I think we talked about this when you were presenting at the live event back in Sydney on. There was a question, I think it's worth going back to it again, only because I'm a member of ART, and I see now we're merging with Telstra, which we previously had merged with Q Super. When I started, it was Sun Super. So, I mean, that is another big push from whatever, government, treasury, APRA, ASIC, to narrow down the amount of super funds in the market. So maybe just the flow-on effects for Wrkr of these super funds just becoming a smaller and smaller number, but the scale is just becoming huge.
Correct. I think we won't see a total consolidation because there are some smaller funds that are very high performing. So it's really about performance is what the regulator's trying to drive down, move out non-performing or subscale. But you're right, at the total number is definitely shifting. It'll shrink. And the key is making sure you're in the large funds, which are more likely to be the net acquirers. So, for us, providing Sun Super was, so I'm glad you say Sun Super, Telstra. Sun Super was our first major super fund client. And as we helped them build Beam, and we still license our technology into that, well, Sun Super merged with Q Super. Beam has remained the dominant force as they picked up 3 or 4 additional funds. Telstra, like Qantas, a couple of others, that will all continue to flow in, and that will be a net positive for us. So who you get in, where your footprint is in the next 12 to 24 months, I'd say 24 months, is really going to define your positioning in the market under any level if the market continues to concentrate. Those big industry funds that we focus on and why we focused with MUFG, we see them staying as large dominant players and more being the net growers than the other way because they have such a prominent position. So yeah, it's playing into our hands, but it's definitely going to make it tighter for new entrants.
Yeah. And then just the kind of to play devil's advocate on that then is, obviously with more members, when the SaaS contracts and renewals come up for discussion, they've got kind of more pricing power. And then, how are you thinking about navigating that, or have you had those conversations where they're kind of, trying to push down the fee because, the last time we put this in place, we had 1.8 million members. Now we're on 2.4.
Yeah. Well, look, and so for us, contract terms are typically a 3 + 3 + 3, so 3 years plus the extensions. CPI are typically built into our contracts. So we're going up even if we get squeezed to come down. We're not coming backwards from where we are. There's a genuine cost to deliver services. I think the second part is there is increasing complexity. And so one of the areas we've focused very heavily on is the security and the cybersecurity side. And that's an increasing field. So if you can keep your prices low, and we're talking $7 ARPU per member, if a member's paying $7 a year to ensure that their data is secure, they can have a digital interaction, there's rich information about them, and their contributions are flowing accurately and being reconciled, it's a pretty low cost when you break it down to a weekly or a monthly, right? So we've stayed low. We've come in hard to cut this market hard because we believe we built an efficient model, right? So that's one. I think the biggest though is the partnership with us. When you roll this out, it's using our AFSL. We're doing the director consents and the direct debit pay, we are the payment processor. So to swap us out, the last time the Superfunds did this was really when they built the system in 2009 to 13. So this is really us coming into the market now, and the work that we're starting to underpin. It's a first major change. We're not expecting them to change again, because there is an impulse to your customers to go out to businesses and say, we've got a new system underneath us here. We want to train you in that, and we want you to use it. So that's once you're in, the moat is deep and wide.
Yeah, and especially with, I mean, payday super as well is, from a compliance standpoint, one of the biggest changes we've seen in a long time. I just want to draw people's attention before we wrap up here. If you look in the chat now, I've uploaded the latest RAS research report that came out after Trent released the 4C last week. So if anybody wants to download that, you can grab it in the chat, or for anybody who's following along online on YouTube, it is available on the RAS research website. Trent, thank you very, very much. We're just about up on time, and I do see our next presenter is joining us. So yeah, hopefully we can get you back in maybe later on in the year.
Looking forward to it. Thanks, Mark. Really appreciate it.
Yeah, thanks for joining us, Trent. And we now flip over to Martin Filz, who is I'll go as far as to say a kind of friend of the podcast, friend of the event here, a regular with us. Martin, you're very welcome back.
Thank you very much, Mark. I see you so often, people are going to start talking.
No. If you want to start sharing your presentation, Martin, I'll let you know when I can see it coming up. And it's coming through now. Yeah, and then if you want to flip to, I don't know, slideshow or full screen mode, just so we get it in full cinema view. Yep, there we go. Perfect.
Great. Well, look, thank you for having us back again, Mark. It's great to be here, and for Raz for sponsoring the event. Fantastic. And thank you, everybody, for joining the presentation. So a little bit of an overview of Pureprofile. I'm going to talk a little bit about the history for those of you that don't know Pureprofile. Then we'll get into unaudited full-year results, because we've just had those out, and quarter four. So for those of you who aren't familiar, we're a data company. We're a 24-year-old data company. And basically what we do is we bring together, we connect answers with business questions and business problems. So that might be organizations, the government, who are thinking about launching new policies, and they want to understand, will it work with their voters? Will it work with opposition party voters? Mercedes thinking about launching something in electric vehicle cars. What would the drivers be for people using electric vehicle cars? Advertising, will it work with my target audience, etc.? There are consistent business questions that are needed for companies, and we connect them with the answers in the marketplace. How do we do that? What do we do? Well, we have the right audiences around the world. We have millions of people around the world who work with Pureprofile, and we receive their data, and/or we generate data by them doing online services, and we connect them with the right businesses, the right answers with the right questions. How do we do it? As I said, we have millions of people in multiple countries. In the last year, we conducted research in 90 countries around the world from our 13 offices. And why do we do it? Well, we do it because it is better for the consumer to have better products, better messaging, better target, and obviously it's better for the business or the institution or the university or the government, etc., to have the right people at the right time getting the right message. So that's what we do, but at the heart, we're a data company. I've been in the company almost 4 years, coming a couple of days short, and we've had the same strategy we put in place 4 years ago. So number one, being a true global business. So when I joined, we were in 5 countries. Our offshoring service for our managed services, we're in India. We're now in India and Philippines, and today we're in 13 countries. So we've had an absolute focus on growing that external international business, Again, when I joined, about 80% of the revenue was based in Australia, and in the last quarter, 43% of the revenue was international. So we're leaning into that larger businesses, larger opportunity around the world. And guess what? It's completely transferable what we do, especially with the global systems, and as talked about global outsourcing that we have in India and Philippines. Second part of the strategy, growing out that platform service. So the key thing always we ask ourselves is, how can we be faster? How can we be cheaper? And how can we increase quality? And having a platform operation enabling clients to come directly from their systems into our systems, maybe that's through DIY or through APIs, but it's direct connectivity, allows us to really tick those three boxes. And again, 4 years ago, we had almost zero platform revenue. And in the last financial year, that was over $10 million and about 20% of our revenue. So clearly that's a good direction that's worked well for us. And those two areas of investment, growing internationally, growing platform, we delivered. And that enables us to really focus down on more data so we can answer more questions, work with more clients, and therefore deliver more insights. And key thing is having that proprietary data. So that's the clear strategy we've had. As I said, in a snapshot, today we're in 13 countries. We're a 24-year-old business. We have 800 clients, about 220 staff, 48.1 million in revenue last financial year. Hit our maiden NPAT profit, so truly profitable as an organization. I'll talk about that in the financial section. 91% of our clients are repeat business, so we do exactly what we say we're going to do on the tin, and clients keep coming back to us. And $10.4 million in annuity revenue, so in those repeat and in those long-term contracts. In a diagram, really what I talked about. On the right-hand side, we've got all of those audiences in aspiration in financial year 25, so that will grow to 50 million plus global audience around the world. And those are made up of our own panels. We have partnerships such as Flybys in Australia, Sprive in the UK, that build up audiences for us, so audience builder panels. And also we work with a partner panel network when we're missing a few people that we might need for studies. And then we work with clients through APIs, direct connectivity, or direct managed service. And then the connection in the middle, and on the left-hand side, we've got clients with their business problems or business opportunities, and they can access our services through managed service, Insights Builder, DIY tool, Audience Intelligence, which is a database product. And then looking at, we've just expanded into qualitative solutions. We've rolled out a number of AI solutions and direct-to-client solutions. So expanding in those sort of light orange type areas. And then clients connect, again, APIs, direct services. So in a picture, that's what we do. Bit of our growth journey. So in 2020, we did a company restructure. We did a debt to equity swap. I joined the company to do that. We refreshed the executive team, had a clear focus. We've talked about the strategy. And the goal in the company then was to grow internationally, also grow financially. And from about 2 months after the restructure, we were operating cash flow positive. So that was an absolute goal for us, not need to raise money to keep the lights on. And then as we've moved forward, we are now NPAT profitable as well. 2023, it was about investing in our people, our data, our panels, and also our technology, which we were doing. So as we were growing as a growth company, which we are, we were also becoming higher EBITDA margin, heading towards profitability and improving the business. So as we say, we're changing the wheels of the car as it's still moving. And then 24 to 26 is really a focus now in growing from that platform that we have, both of technology, audiences, and the right people in the right locations. So really accelerating that growth element that we've always been as a company. Why do we do that? Because the opportunity is globally. So Australia makes up about 2% of what is in the data and insight space, $130 billion market. If you're not in the market, you might not know it exists, but it's 130 billion US dollars. Every product you've bought, ads you've seen, car you drive, most probably clothes you wear, the computer you use, all of that has had some element of market research conducted to ensure it's right for their chosen audience, a big audience, big opportunity. And when we look at the share around the world, the UK market is about 6 times bigger than the Australian market. We've been there for 10 years. We now have a really strong business in the UK, so it's about growing off that platform. And the US business, where we only do a few $1 million a year at the moment, makes up 55%. That's about 35 times bigger than the Australian market. So 25 focus on the UK, really growing that out even more, and then 26 focus on the US. And on the right-hand side, I've got a nod towards AI because everybody's talking about AI, and it benefits our business in 3 areas. The first area is internally. How are we doing what we do? As I said, faster, cheaper, and with a higher quality. And we've got a number of AI solutions that we've rolled out that have made our business all of those 3 things. Then the second area is looking at client delivery. Where can we use AI in delivering our solutions to client? And we've got a couple of areas in there that we've rolled out and new ones in the pipeline. And then the third area is these are our clients as well. These are new clients that we didn't work with before. Because when you do a ChatGPT search and it brings up answers, guess what? They need data to feed that engine. And where do they get data from? Companies like Pureprofile that have proprietary owned data, and it's a great accurate source for them. What's the prize? Well, our global peers are 150 million Australian dollars to $1 billion Australian dollars in revenue. We're only 48.1 million Australian, so we've got a lot of headroom there. Why? Because they're particularly strong in the US and the UK, and they have direct client solutions. So what have we been doing? We've trebled our business over the last few years in the UK, trebled our business in the US over the last few years, and rolled out end-to-end clients. And we are truly, on the right-hand side, Tailwind's a true growth company. So we have an absolute focus on data quality. There are issues in our market because the data is not proprietary and owned, not within Pureprofile. Our peer group businesses are challenged because maybe they've had takeovers or private equity, etc. Well, we're winning market share from them. We continue to attract amazing people to Pureprofile, again, from competitors that perhaps are faltering, and people want to join a growth successful company. And then the other tailwind is this rise of AI, which is about innovation. It's about being able to roll out solutions faster and about being able to work more efficiently. Few achievements in financial year 24. We grew at 10% as a company at the top line. We achieved our maiden full year net profit after tax of 100,000. And that was from a net loss of 1.9 million in financial year 23. So a real focus on the business in turning us to an NPAT positive position. However, without losing the growth element. So we still managed to grow 10%. We achieved our guidance at 48.1 million revenue, 4.4 million EBITDA, and we had 5.2 million cash balance at the end of the year also. As I talked about growing internationally, we increased rest of the world revenue by 43%. That's where we'd put our investments in financial year 23 for 24, and we'll continue putting those investments as we did at the end of 24 to achieve continued growth in 25. And that was up from 38.5% share of our company in financial year 23. So real focus, 91% from repeat business, 5 new AI solutions. We opened 2 new offices in Spain and Germany. We were winners of the Australian Research Partner of the Year Awards. So that's our clients, the industry clients voting on the best partner and supplier in our industry. We won that. So that's a great endorsement of the business. And then 3 other awards that we won. We were top 50 inspiring workplace in the UK, 4th place in Asia, actually hot off the press last Friday, I think it was, we were 5th place in Australia. So again, talking to how we ensure that we put employees, team members first, because that then results in clients wanting to work with you and increasing revenue, increased profitability, running better as an organization. We also, at the end of the year, made our first acquisition in the 4 years that I've been here. It was a smaller version of Pureprofile based out of Australia, 1.25 million, paid over 2 tranches. That business, approximately 2.7 million of revenue, over a million surveys conducted by that company. So iLink is part of the company now. They've got a great panel business that we've augmented into our business, 17 people in the operation that we've brought into the company, over 50 clients that they work with. And that was over 3 weeks ago that we started the integration, and that's really gone very well. And the bottlenecks that we knew that were happening in iLink around having more operation staff to do more work, or having more data points to answer more problems for clients, we've immediately alleviated those. So we've seen them being able to do more work with their client base, which is fantastic, as well as we see many synergies within the two businesses working together. Some of those are operational, some of those are client-wise. So we're recognizing synergies as well as growing the revenues of both companies. So really pleased to welcome those fantastic 17 people to our business. Now, as I've talked about, since financial year 21, we're looking at the quarter numbers here, and we can see the great growth that we've had. Our share price hasn't done the same, and we know microcaps have obviously been hit during the current economic cycle. However, we really feel that we are in absolute position now to grow out that share price. We've got a growth company. We're NPAT positive, obviously operating cash flow positive for a number of years now, growing out that international business is a true, really good Australian story of taking Australian product and rolling that out into other markets. 800 clients, 200 staff, 24-year-old business. So now it's really about getting out, and we've got fantastic funds coming into the business, but bringing in new funds, working with us, bringing in new brokers, and really growing the awareness around Pureprofile now. And that's a focus for us in financial year 25. Bit of financials, as I said, revenue went up 10%. We made our maiden NPAT profit, which we're very proud of. EBITDA at 4.4 million was actually 4% down, but we had a slight change in the way that we paid executive STIs, and instead of being dilutive share-based, they now are cash-based, so that we paid less out. We had 0 dilution on those for our shareholders, and actually, if you did a like-for-like, it was 8%, the 9% the EBITDA margin, and about 8% up. So slight change we had in the way we did our accounting, but the key thing for us, 10% growth and 106% improvement on NPAT. So really pleased with that, and that cash in the bank up to 5.2 million. ANZ grew 2% in the year, rest of the world, which we had the focus, 23%, and our platform grew 88%. And here we can see some CAGR growth, 16% on the revenue, 38% rest of the world over the last 4 years, 102% over platform, and 14% over EBITDA, as we've invested in the company to grow out internationally. Looking at the quarter, we had record quarterly revenue of $13.1 million as a business. That's up 18% on the previous quarter of the previous year, so the 23 quarter 4. That's 18% up, 13% up on the EBITDA. ANZ was up 7%, rest of the world up 38%, and platform up 59%. In actual fact, on PCP, EBITDA was up 23% because, as I said, we made that slight accounting change. So really fantastic quarter 4 that takes that momentum into now that we're seeing in quarter 1 of financial year 25. Again, similar numbers, 12% Quarterly CAGR 34% on the rest of the world, 76% on platform, and 14% in EBITDA. So very, very similar Q4 CAGR to our annual CAGR. What do we look at for 25 as key initiatives? Well, it really falls into carry on that international expansion where we're leaning into where we have low market share, bedding down that acquisition that we made and ensuring that we're realizing all of the benefits for both organizations at the top line and also at the bottom line, growing out those data points, continue to invest in technology. We're now NPAT profitable, so absolutely growing out that NPAT profitability to meaningful amounts. And again, beyond 25, it's really about focus on the shareholder value, on investments for the business, and keep doing what we say we're doing and doing what we've done for the last 4 years. So as I said, in summary, first NPAT profit after tax, we've got revenue up 10%, so we continue to be a real growth company with that record number in Q4 of $13.1 million of revenue. Rest of the world up 23%, where we put all of our investment. Cash 5.2 million, up from 4.2 million. And we're also, by the way, on the cash front, we have a small debt of 3 million, and actually we're also paying the principal of that back now. That's with a top 4 bank. So we're paying that back. So really pleased to be doing that. And then we made our first acquisition. So there is a little snapshot of Pureprofile. So with that, back to you, Mark.
Thanks, Martin. And I just want to draw, while Martin was doing his presentation there, I'll just draw your attention. I did upload into the chat the latest updated report from RAS on Pureprofile. So if you want to download that, you can. And for anybody who's watching us back on YouTube, that is available on the RASK website. Martin, just a couple of quick questions there. I might just kick it off. You know, as we're kind of trending towards, 50% now in international revenue, obviously exchange rates start to come into affecting profitability and swings between, UK and Aussie dollar, US and Aussie dollar. How are you, kind of managing that yourself and Melinda? And, is it kind of getting to a point now that, as people, I just quickly looked while you were talking there, 3 years ago, we were at, 80 cents to the US dollar. Now we're back down around like 62. So, people think, oh no, the Aussie dollar saw was around 60 something, between 60 and 70, but actually not too long ago it was 80. So maybe just talk about how you're managing that impact on profitability now that it is becoming, a bigger and bigger portion.
Yeah, good point, Mark. And yes, that's something we need to think of as you become an international business. It's around where do you have back office support, and where do you start to put people that you need to deliver, as well as financial elements. So we have multiple jurisdictions we operate in, and we have multiple entities now as a business as well. What we tend to do, we don't tend to hedge as such, but we do have costs in each of the markets. So what we tend to do is actually, because we're operating cash flow positive today, is to leave those funds in each of the markets. So on a reporting level, it might look like we made a small loss or a small profit as a reporting level, but actually we haven't made a real cash loss because we're leaving those funds in the markets. And should we need those, then yes, it might be realised and brought back to Australia. And that hasn't been the case thus far. And we're able to, as I said, we've got UK salaries, we've got US costs, etc. And so those funds get used in each market. But it's something we need to be aware of, absolutely, Mark. And it's some sophistication that we need to bring into our business as it continues to grow. And I would hope we see a tipping point of sort of over 50% at the end of 25.
And the growth, and maybe we can touch on from 24, but I'm thinking more in 25. Is it more doing stuff with existing customers that's, really, really driving the growth? I.e., you're working with Coca-Cola in the Australia market, and now, they want you to do something in the Spanish market, or, a kind of word gets around internally. Or is it really coming from new customers you've never engaged with before, in from whatever market it might come from, US, UK, Australia. Maybe just touch on what is driving the growth over 24 and now moving into 25.
Yeah, so it's sort of we wear two hats. So in the ANZ market, we're market leaders as a business, and so it's about existing clients and actually bringing them new solutions, bringing them the new products, and still there's room to grow our market share in the market. So ANZ is very much about existing clients growing out new products. In the rest of the world, it is, to your point, it is our global clients saying, great, you're now in this market, we're able to work with you. As I said before, we worked in the last year in 90 countries from our 13-country base. So that's clients wanting us to work in new markets. But predominantly, it's about bringing new clients into the business. So Australia is quite interesting in the data and insight space. It's a very insular domestic market. So 80% of the work that we do in Australia is really domestic market. In markets such as the UK and the US, it's lower than 50% is domestic because you've got head offices that are doing international work. So it's rather than us opening up in Spain and it's an Australian company saying, great, you've opened up in Spain. Actually, us opening up to Spain is it's a UK company going, great, we now will do Spanish work with you. So it's again helping us grow, compounding that growth for our international offices by opening more international offices.
Yeah. And then just on the international offices, the US, I noticed in your slide you were saying, strategic investments and you're running sales kind of remotely and stuff. But, is there going to come a tipping point where, a bit of a further investment or more concrete investment is going to be needed in the US office to, lift it on to kind of the next level? And is that, something that, we should be expecting in 25? Or can you kind of still grow from kind of what you've got now in place?
Yeah, 100% what you just said, Mark. So as the UK, 10 years, we've now got a really solid base of clients and team members to grow from. And the UK is a relatively small market. Most companies, are in London or Manchester, it basically is. So it's a couple of hours to get to them. So it's very easy to grow that out. US is a big beast. And we do that remotely at the moment. And as a company, you can spend a lot of money making not much noise and they'll pebble in the ocean. So for us, the approach into the US will be continually grow our remote business that we do. In actual fact, we just came back. We now exhibit at major US events. And we just came back from a big event, an industry event in New York. And I was talking to my MD of the region the other night. And actually, year over year, our work in progress today is 50% up on the back of going out to events and people now getting to know us. So we can continue to do that remotely, but organically, but you're not seeing the prize and you're not really seeing the opportunity. So we've really got three ways that we look at, we will move into the US. And number one, we have the audience builder product. So finding a partner, big partner equivalent in the US, like a Flybuys here, but in the US, gives us the ability to really open up quickly a niche audience, a niche data set that we can get our name known, that we can launch on the back of and using on their coattails as well. So that's one opportunity, and that's a lower cost than us putting our hands in our pocket growing out data sets. The second way is in partnerships. So somebody that's maybe doing got data, but they're offering a service adjacent to what Pureprofile does, and us actually coming in and offering our quantitative services and monetizing their data sets by doing what we do. We're having a few discussions with large US companies where we can partner on the back of them, offering them a new service and then going out to clients. And the third one is looking at acquisitions. Which immediately you've got a data asset, they're using the data asset, you've got a brand, a number of people, and again, overlaying that Pureprofile magic on top of that. So they're the three areas that we're looking at. And that really is, as I said, 25 is all about growing out further the UK business. And then 26, the aim is to have in place one of those three so that we start to recognize that US growth.
Okay, perfect. And then, yeah, my final question was, just on capital allocation. You touched on the share price there, despite the kind of operational improvements. Is a buyback something that's potentially going to be considered in 25, or paying a small first dividend, just to get that kind of marker into the market as well? Maybe just to touch on capital allocation. What's the kind of board's feeling on to as something else to kind of trigger the I guess the market's attention around what you're doing from a share price perspective.
Yeah, really, yeah. Again, you asked very good questions, Mark. So everything's on the table. I mean, the bottom line is we had a board refresh at the end of the year. So we've got a new chairperson, Michael Anderson. People might know him from O Media, took them pre-IPO into IPO, strong media background. And it's been fantastic just in the last sort of 8 weeks working with Michael, seeing how his mind works, and looking at that growth and the opportunity and thinking in a different way of Pureprofile. Another new board member we brought in is a guy called Adrian Gonzalez. He very, very senior executive at Kantar, which is a huge business in our space. He headed up Asia Pacific, or Southeast Asia, sorry, I should say, for the company, and that's several thousand team members. He's incredibly well connected, and again, making us think differently and really having that support of now a really strong board. So that's one thing. We've now got a refreshed board, so excited about that. We've MPAP profitable, continuing that 10% growth, so we've got a story there. We've made our first acquisition in iLink. We've got good numbers on the growth. We've demonstrated investment that we've made has every time turned into increased top line and bottom line. And now with that story, it's really now time to let's put a push before we start thinking about share buybacks. Let's actually really put a drive on finding a new broker for Pureprofile, bringing in new funds, getting that message out. We work with the IR department, who are really a great partner of ours. We work with Finola at Raz, is a great partner of ours. Let's look at this quarter. Let's get out to the market. Let's talk to them about the great story, and then let's see how that beds down. And before we make any decisions, we normally give guidance at our AGM, so that fits in sort of end of October time. So let's see how the share price is doing before we decide to do anything such as share buybacks, because we turn money into results by investing overseas or making an acquisition. So let's hang on to see if we get a response in the meantime with the extra energy we're putting in quarter one.
Okay, perfect. Martin, great to have you on with us as always, and thanks for joining us. We're unfortunately going to have to leave it there, but I'm delighted to say we can welcome our third presenter of the morning, and a welcome back to Michael Ivanchenko from Kinatico. Michael, how are you?
Great to see you, Mark. I am very well.
If I can just ask Martin, please, to stop sharing his screen, and then Michael, you'll be able to share yours. Thanks, Martin. So if you want to get your slides up, Michael, I'll let you know when I can see them.
Thank you. It's loading options. Of course, I've got a security setting to allow Zoom to share. Let's just quickly update that. Mark, it's telling me I need to restart Zoom, so I'm immediately going to do that and come straight back in.
We can hold on here for a minute, no problem.
Thank you.
So just actually while we're waiting for Michael, I am going to upload the latest RAS research on Kinatico. Let me just grab it here, which incorporates their last update and foresee to the market. So people should see that coming through in the chat in the next probably 10 or 15 seconds. And for anybody who's watching this on YouTube, please check out the RAS website for the Kinatico report, but reports from all of the companies who are presenting with us here this morning. So that'll be Wrkr, Pureprofile, Kinatico, and Pointerra, who are going to be joining us after Michael. All of that research will be available on the RAS website for anybody who's joining us via YouTube. Michael is back with us. Michael, if you want to...
Let's try that again.
Try that again. And hopefully we'll be rocking and rolling this time.
Momentarily. And
yeah, I can. It's just loading out. Yeah, I can see the cover slide of your deck now, Michael. You can take it away.
fantastic. Thank you. Right. So first of all, delighted to be back with Coffee Micro. Today I'm sort of giving an overview of the FY24 performance and a little bit more color on some of the recent flash announcement, but also going through primarily more color around our performance in our SaaS transformation, what we've achieved, and certainly hopefully give everybody a picture of where it's going. So straight into it. First of all, as always, I'd like to pay my respects to the traditional custodians of the land upon which we gather, and pay my respects to their elders past, present, and emerging. So straight into it. We launched our SaaS compliance product at the very beginning of FY23. Since that time, we've actually seen a 58% CAGR, and we have no reason to believe that that won't continue. Our sales pipeline continues to grow, and certainly seeing no question about demand in the market for simplifying the whole process of managing compliance within an organisation. And fundamentally, that's what's been the driver for our SaaS growth. So the meeting customer current and future needs, being a trusted advisor and a resource for information around what's coming up, challenges, but then very much spending time with organisations to understand their pain points. And it's really been clear that our advantage is not being a compliance platform. Our advantage is being a platform that simplifies the administrative burden, the cost overhead in time, in people, in the opportunity cost of people within organisations not spending time on the reason they are part of that organisation, but effectively fulfilling a very important role. So recognising the absolute importance of compliance, every business has an obligation around compliance. Those requirements are becoming materially more complicated, and they are multiplying. At what used to be the case of a relatively well-defined and stable set of requirements has now transitioned into requirements and obligations coming from multiple sources, external and internal, along with shareholder expectation, board expectation. The whole idea that compliance is no longer seen as a task that must be done and is reviewed in the case of an incident, to something that is expected to be embedded within the day-to-day operations of an organisation. Once you get to that point, making sure that being able to accurately adhere to those requirements in the least disruptive manner becomes incredibly important. And that is the space we play in. So the other thing is that across the myriad of other sector enterprise products that go into an organisation, whether that's HRIS platforms, whether it's workforce management platforms, payroll systems, etc., etc. They will all have or claim to have some portion of compliance management, but it's effectively an add-on. And further, it is focused on, again, the actual outcome of the compliance. There's not a real focus on the user experience and the simplification. So our whole advantage is, and we've got this direct feedback from our customers, has been around making their life easier. The risk manager who gets to 3 o'clock Friday afternoon and is frustrated and sick of chasing workers for pieces of information that were absolutely, have to be submitted by Friday 5 p.m. is eliminated. Our platform does that, and it escalates and it tracks and gives you all of the tools to be able to simply be the overseer of that process rather than the one driving it. So the other way to think about our platform is when I mention things like HRIS or the other workforce management tools, et cetera, is we don't compete with them, we welcome them. The function of our platform is an aggregator of all of the enterprise data while securing the digital connection to workers for that information where required, whether it's procedural in confirming a start of shift safety list, in healthcare confirmation that you have no symptoms or anything precluding you from doing your shift today, and the appropriate PPE you have access to it, et cetera, and all doing it in a secure way to further protect the privacy of data. Our platforms are all security by design. It's imperative. Customers trust us with a myriad of data that flows through our system, and we are very, very focused on that. It is the highest priority we have in our company. And then further, the need of simplifying compliance is global. So the opportunity, I've spoken about it before, and it certainly remains a key part of our strategy, is that following the expansion and further expansion and growth within Australia and New Zealand, this is a product that translates perfectly to any market. Our product is compliance requirements agnostic. If there is back to source verification of credentials or screening, anything required as part of that process, we can integrate with whatever local source is required. And whether that's via a partnership, white label, it doesn't matter. The platform has been designed to do that. The benefits of simplifying the entire day-to-day process, however, is universal. So let's have a look at our FY24 results. Our annualized SaaS revenue based on Q4 was 11.2 million. The overall year on year, we've seen a 90% increase in our SaaS performance. Significantly is that 2 million of that growth has come from brand new contracted customers during the course of the year. And so we have already that known revenue stream leading into this year and the next of a further pool of contracted customers who will increase their revenue contribution over the following months and years. We've seen an 83% uptick PCP on our percentage of revenue that was SaaS, and it's now at 34%. Significantly, Q4 was 38%. So that we have an objective to get at least 80% of our revenue to SaaS over coming periods, and we see that eminently achievable. The other thing to actually look at across some of the key brands of our customers, all sectors, all areas, and our targets of mining and energy sectors, along with healthcare, along with education, are our strongest growth sectors. But the other one I'll point out there, and I'll mention that a little bit further as well, we have continued to win government departments. And the significance around that, even if they're not the largest revenue contributor, not that they're not insignificant, but it is the fact that the fact that governments and government departments, with all of their due diligence and investigations, trust our security, trust our process, and see benefit in the simplification process, actually makes, well, A, is a point of validation of the platform, but B, further, it is really helping us with other prospects and other organisations. So when they ask us about, how do they do their due diligence and what are the things that they need to look for, the conversation that says, well, this, and this government department uses, pretty quickly brings an end to the conversation. And we certainly see that being a big asset. And then announcing a new major label. So in this last quarter, we've closed the Kmart and Target group. We see that as a very big opportunity that will grow over time. And obviously, as part of Wesfarmers, that is very, very interesting. We've achieved all of those growth metrics, the increase in revenue, the drive, etc., while having an increase to our net promoter score or our favourability rating amongst our customers, an industry average of 55.5, and we've achieved a 63. So very happy with that stat. You do not achieve particularly SaaS growth without a strong customer satisfaction rating. It's a further point that, and not mentioned on this slide, but to outline it, since the launch of our monitored compliance or simplified compliance product, we have not lost a single customer. Right now, our churn is 0. So all of that, what does it translate to? We've had a 225% NPAT increase, now at $800,000. It's to put that in perspective, because quite frankly, I'm nowhere near satisfied with the 800. But a couple of years ago, I think the group lost about 1.8 million per annum. So it's a material turnaround, and you see the total revenue there, along with EBITDA increasing 43%. So where do we see our advantage? Where or why are we confident in the future? All of the things that we have on this page in terms of the position we have today, we believe we are very well positioned for ongoing SaaS growth and increased profitability, etc., all of the metrics that shareholders expect. One of the key ones, and I make this point, it's one of the first times we're starting to outline the story in this way, because I don't think the market has truly understood the growth of our SaaS base, the direction and the trajectory we've been on. And I suggest people think of us as a startup who's been achieving 55% CAGR on our SaaS product. And by the way, we have $20 million in legacy revenue that we can also call upon. If we were a startup that had just acquired CV Check to be able to mine their customer base for conversion to a higher value, higher revenue SaaS product, I think we would have been viewed very differently from the start. But that is how we should be thought about. So across the group, over 10,000 existing corporate data verification customers generating the $20-odd million in legacy revenue. They are our advantage certainly amongst other startups, in that we have a ready built-in pipeline of connections and relationships with customers that we can take on this SaaS journey. Further then, we've seen material increase in the number of integrations and organisations coming to us to integrate, and all of which give us further outlets and opportunities for growth at a second and third party level, and particularly calling out the addition of APRA for medical connections, and also Workday are obviously highly significant. So what are we planning for FY25? In short, continue to build out and answer that customer need and customer demand. We have instigated over 500 customer interviews and connections and industry panels where we gather feedback. We get the information from customers about what they're looking for and what they need. And in short, the headline of it all is self-service. They want to be able to dynamically create their compliance requirements, not rely on our professional services teams, so that they can actually, in real time, generate a new requirement, almost drag and drop it straight onto a role or a worker or a department, and it immediately flows out through the system. We will deliver that this year. That drag and drop idea that the next iteration of our user experience will be a drag and drop. Here's a requirement, whether it's predetermined or one you've custom created, a connection to a new learning management system for cybersecurity training or whatever else it may be. And you literally can drag and drop it onto, as I say, a role, a worker or a department, and immediately they will be notified via the on-site app that they've got a new requirement. They can complete it right there, right then. The same along with the dashboards, being able to dynamically create intelligent AI-enabled dashboards that give them exactly the views that they need for their role, for their time. And you can create as many as you like. Along with features in on-site, we'll be creating around geolocation when you enter a new premises, a new site, particularly for aged care workers or disability workers, somewhere they've never been before. Are there induction requirements? Is there anything that's changed since you were last there or has happened recently that you need to react to? All of that intelligently driven by the platform, along with alerts and alarms. The idea of being able to submit via the on-site app, if you've got an incident report you need to complete, if you've got any kind of instant emergency, you'll be able to do that via on-site. And along with then triggering all of the incident reporting or whatever else is required in that instance. And then in something I'm very excited about, we've been working on, and we will launch this year, an integration to a risk matrix. When you have your inherent risk and then moving to your risk mitigations, those mitigations will automatically create compliance tasks. Because if they're not done, you can't demonstrate that you've mitigated the risk as you've committed to doing. So now you get real-time visibility of your mitigated risk across the organisation and the awareness and alerts and the ability to intercede in the situation where they're not done. And then further integrations and expansions across our distribution partners. This is about growing. We've been very happy with our progress to date, or more importantly, I think, very happy with the confirmation from market of our product market fit and the opportunity that will continue to grow and the need within the marketplace. And making it faster to bring customers live via the self-service means we can actually translate those contract wins into revenue faster. So bottom line is we've demonstrated since we've launched the product that we've got proven execution. We've taken the company profitable, and now again for the second year, we're cash positive for the year. So all of the metrics showing the right trajectory, some of them are 55% CAGR, I'm very happy with. So we believe it's time to invest and accelerate. We have the resources to do that. Over $10 million in cash sitting in the bank. I'm asked all the time, what are you going to do with it? Well, time to accelerate. And we have the ability to do that within our ongoing operations. So I'm very excited, very bullish about the year to come. Mark, back to you.
Thanks very much, Michael. We had questions flying in there while you were talking, so we'll try and get through as many as we can. Apologies if I don't get to your question. First one, Michael, we'll touch on how much revenue is coming from integrating with third-party customers now?
Look, I don't have that number off the top of my head, but or the accurate one, if I was to give you a number, I would say somewhere between 25 and 30%.
Okay, perfect. And then a question on how is your go-to-market team structured? Are they targeting specific end customer verticals, or are you spending on trade shows, outbound marketing activities, maybe just how you're attacking the market, maybe?
It is very much targeted by sector. So we do a lot of webinars, hosted conferences amongst various sectors. So we recently did one in Queensland where we were invited for the top 10 aged care providers. invited us in to present both the challenges, the upcoming situations, and then some of the ways that organisations can better manage their compliance workflow. We were invited in because we had one of those customers already. Within 6 weeks of that conference, we had 3 more. So it's a really good example of that one. We do some trade shows, etc., but it's not the primary target yet. So we have very much found that sales get sales within word of mouth recommendations, etc. And that focus and the number of customers we've added over the last year has been more than enough to keep our sales team busy. And then along with the invitations across various RFPs and RFIs that increasingly drop into the door.
Okay. I know you touched on it in your presentation on I think you said it was a 20 million in legacy revenue. We've just got a question on that. You still have a base of legacy revenue customers. Have you systematically harvested this pipeline to convert them into SaaS, or is it still largely untapped? Is it, their contracts come up for renewal and then you initiate the conversation, and that just takes time to roll through the system?
Yeah, that's a great question and fundamental to the strategy. We are very systematic and identifying them, but we are at the beginning of that opportunity. So, again, off the top of my head, I think we're about 20% through the currently identified opportunity. And that leads to a further point in the way we will view that product space. While it is, and I refer to it as legacy revenue, it's not that we are going to stop offering it. So the CV Check brand is very well recognised. It's very well understood. What I can see it converting to in years to come is purely being a sales acquisition tool. So somebody approaches us because they need a bit of data verified, whatever it may be. That is the opportunity for us to open the conversation, even if we just fulfill that initial request. Because once you've got the relationship with them, you learn we are very systematic about understanding why they're collecting it, what stage they're at, what process. So when we discuss with them the SaaS product, it's not by the way, we've got something else you might be interested in. We come with a informed position of why it would benefit them. And that's one of the reasons we've been very successful in the conversion rate to date.
And yeah, the CV Check, it's a low cost, entry into the system. It's not a big hurdle for them to jump, but as you say, it does open up a broader, more complex and something with more deeper context into the sales conversation. And then a question on what I think they're referring to SaaS here. Typical customer size, contract value, targets, length of contract, sales cycle, maybe just I know there's a lot in that, but maybe just kind of give broad stroke overview of a typical SaaS customer.
It's it's always very hard to put a framing around the typical sales length of the process. We've had some that have signed within a week. We've had some that have taken 10 months. And quite often the larger ones are the faster. The big thing that, again, in some of the stuff we're aiming for FY25 and the self-service, etc., we're going to see the ability for organisations to download access to the product and try it for free for a limited amount of time. I think that's really all the usual stuff you'd expect from a digital SaaS product. I think that's really going to help us with the smaller end of town, because our primary target customer at the moment is 400 or 500 staff minimum. We come into our own when you're in the thousands. The contract term we have, it's a minimum of 12 months, but we have contracts up to 5 years. And obviously there's commercial benefits for those operators or organisations in the longer term. The typical contract size, without putting a number, I'll share that when we first announced HireUp was one of our first big SaaS wins, and we announced, if I recall, about $250,000 per annum. Most of the contracts we won this year are in excess of that, but they're not big enough now for us to even announce. So then you get the larger ones. We've done one today. That you start to get a picture. We announced BHP renewal because we already had them as a customer. That has they've re-signed for a further 3 years, and you're talking millions of dollars in annual revenue. So it's it is at the moment. If I was to put a number on it, because not to run away from the question, I'd say our average size is circa about $500,000 to $600,000 per annum.
Okay. And then I think it's a question more related to your first slide, that kind of switch into the SaaS business. Is there a steady monthly cadence of winning clients, or can it still be quite erratic with kind of big lumpy wins like here and there? Maybe just talk to, now that you're more embedded into the SaaS process, how is it in terms of getting sales in on a monthly, quarterly basis?
Getting the sales has not been a challenge for us. What we have suffered from, particularly in the last 6 months, is it is taking us anywhere between 3 and 4 months to take one of those customers live. Okay. And so we'll sign them, and then for the first couple of months there is very little revenue from them. But then we saw in Q4 all of a sudden there was a jump in the monthly SaaS because a few of them then started to come through. So it's particularly adding some of the targeted features that again I mentioned for this year, which have come directly from customer feedback, is we believe we will accelerate the number of sales wins per month, but also make it faster to go through the process of winning the bigger ones.
Okay, perfect. Folks, we're just out of time here with Michael, and I didn't get to everybody's question. I apologize, but if you do want to pose your question, the email address is there, and I'm sure Michael and his team will get back to you if you do want an answer to a specific question.
Very happy to.
Michael, thank you very much for joining us again this morning, and hopefully
always good to see you, Matt.
We'll have you back in later in the year, hopefully. And if I could ask you to please stop sharing your screen, and we shall get final presenter of the morning on here. He's been waiting very patiently. Ian.
I will drop out, and I think that'll stop it sharing.
Yeah.
Cheers.
Okay. Perfect. Thanks, Michael.
Thanks.
Ian Olson, as I said, from Pointerra. Ian, I can see your cover slide now, Ian. If you want to take it away when you're ready.
Great. Thanks, Mark. Am I sorry, I've just had
your audio sounds fine, but your video is off. Sorry, no, not your video. Your video is on, but I can see, but you're blacked out for some reason. Oh, there we go. Now.
Hey, excellent. Gee whiz. It's a bit hard when you're a tech business to not be able to operate this stuff, but thanks, Mark. Appreciate the opportunity. Thanks, Finola. Appreciate your support of businesses like ours and our sector generally in Australia. And listening to those three businesses prior to our opportunity, it's just great to see how much diversity there is in terms of the sorts of sectors and solutions that have got the potential to go global and be fantastic Australian success stories. So we're I think I was last on back in May, so it's great to be here again. And the presentation I'm talking to today, which Mark, hopefully everyone can see, is our quarterly. So it's the front end of the quarterly, which went out earlier in the week, and I'll jump into that. And great again to see some familiar faces of the attendees. Appreciate everyone making the time. So FY24 June quarter. Just a quick recap though, and I'll keep it really brief because I think a lot of people here know the story. Pointerra, we build digital twins, and what's a digital twin? It comprises remote sensing data and design data for built form, for roads, for rail networks, for power, electric utilities, for water utilities, for mines, for oil and gas facilities, for the buildings. Basically, built form anywhere in the world these days is designed in 3D and increasingly is managed in 3D. And what Pointerra has done has solved and cloudified the workflow around a really challenging problem, and that is working with this data, trying to federate it, see it in one place, create a common data environment so that the significant investment in this remote sensing data can be shared and leveraged across the organisation. To give viewers and listeners a feel for the scale of investment in remote sensing data, some of our US customers spend in excess of $30 million US per annum every year acquiring remote sensing data, and that's anywhere from satellite imagery to imagery and LiDAR collected from planes, from helicopters, from drones. And every other a myriad of different hardware configurations, and that's generating petabytes of data on almost on a daily basis. And capturing the data is not straightforward, but what's even more difficult and levels of magnitude more difficult is managing that data and interpreting it. So we started life back in 2015-16, and first customers the back end of calendar 17 and early 18 with the solution at the bottom, which we now call Pointerra 3D Core, and that's really about creating that common data environment and solving the low-hanging workflow problems, if you will. And as we engage deeper with our customers over the past few years, and led by the success we've had in particular out of the US energy utility sector, we've worked with our customers to help them query and analyze that data now that we've got it in the cloud and adjacent to high-speed compute. And at the very pointy end of our business model is the business insight and the intelligence that we can give at an organisation level around risk management and operations, and we're starting to see that come through in some of our newer sectors, more recently mining, and I'll get to that in a bit. So it is a unique digital twin SaaS business model. There's not really anyone out there that's got a business model like ours. A lot of the companies in our space are trying to migrate from that have got some desktop solutions, and we compete with people that use desktop solutions, and sometimes 5, 6, 7, 8 different desktop software products just to process and interpret data. We've taken that laborious, lengthy, error-prone, costly workflow and we've cloudified it. So born in the cloud, and we're on the Amazon AWS cloud environment. And I think one takeaway for people newer to the story is it's not about storage in the cloud. It's about having that data adjacent to infinitely scalable, near infinitely scalable, high-speed compute. So we can stand up thousands of instances in parallel to run a massive analytics job that for a time-critical customer, such as the work we did with our largest customer, a power utility in the US who was whacked by a hurricane back in 2022, and we were able to give them answers after a plane had landed and had flown their network and surveyed the damage. We were able to get them answers at a really granular level in a time frame they were used to waiting days or weeks for that insight. We were able to give it to them within hours, and it's that workflow that we compress that basically underwrites our value proposition and our business model. Our growth strategy, we've tried to be really consistent and focused on this. It's all about people. We onboarded a guy earlier this week who's well known to the business and is he's based in Australia and is going to be a fantastic addition to our BD and sales team. But we've got an amazing platform, an amazing technology solution, and we think the best business model in the world in terms of geospatial workflow. But it only exists because of people. We've got a core group of founders and management team that have been with the business a long time. They're all shareholders. They're committed to the success of their company, of your company, if you're an investor. And I can't stress highly enough that, you know, the success of our business and the challenges that we face are all about people. I mentioned earlier that we've got some amazing customers, our foundation customers, and it's really those guys, you know, that trust us, that rely on our platform to be always on 24/7 with downtime per annum measured in the seconds. And that level of trust and engagement means that they come to us and say, hey, can you solve this problem? Can you automate and cloudify this workflow that's painful for us? And it's really important for us to get that answer faster. As I mentioned before, the US energy utility sector has been our largest. In the last year, we've given some of the challenges we experienced in calendar 23 in particular, and I guess the first quarter of this year in that space, it led us to make some decisions about investing from a BD and product perspective into different sectors. But what's really important is that we are able to leverage the significant investment we've made in the energy utility sector into those new sectors. But importantly, the work we've done in the energy utility sector over the past few years in the US market in particular is only just starting. You know, we had a great contract win earlier, a few weeks that we announced at the back end of June, and I'll come back to that in a minute. But this growth strategy is all designed and was conceived back in 2015 when we came up with the idea for this business. My co-founders, a couple of the Nearmap early management team, and the former CEO of Nearmap, and our tech team who've been with us, you know, the whole journey, is to be really focused on scaling what's really valuable to the market, which is recurring SaaS revenue, getting cash flow positive, funding our own growth. So, you know, whilst we've come to the market this year to raise capital, which was frustrating for us and clearly frustrating for some of the shareholders, we've tried to be really disciplined about preserving cash and making judicious investments in people as we scale the business. So to jump to Q4, it was a good quarter in an otherwise ordinary year. The irony is it was ordinary financially in terms of the fiscal year, but there was a lot behind the scenes that we can be really proud of in terms of product development, sector penetration, and importantly, the confirmation that what we've been telling the market for the last 9 to 12 months, which is, hey, the US energy utility sector has sat on its hands for a year while it's figured out how to avail itself and plan for this near on $1 trillion capital investment program that's being underwritten by the Biden administration in a program that's bipartisan, regardless of the outcome of the US election later this year. We've been saying, hey, don't worry, the US energy utility sector is healthy, and so the structural tailwind that we see going into FY25 and beyond is significant, and to some extent, we're scrambling at the moment from a resourcing perspective to service the existing and new customers that are coming on board in that market. I'm off to the US next week, and we're having a quick 3-day strategy session to focus very much on that US energy utility sector and figure out what we need to do in terms of the US business to scale that from a people perspective and importantly a partner's perspective to take advantage of that opportunity. So Q4 was a real improvement from our perspective. There was a placement in there, which was something we did during the quarter for that $2 million. Pleasingly, there were some great Australian investors that came on board, some existing customers, some funds that we'd seen on our register over the journey had come back for another look. But importantly, just under half of that raise was through a US-based family office, which in and of itself doesn't sound like much, but the principal behind that family office fund used to work at Sequoia and also at Google, and so a really high-profile investor in the US marketplace, someone who looked us up and came to us and said, hey, as recently as last November, hey, I'm really interested about your business. I don't know, I'm not quite sure how he found out about us in the sea of SaaS investment opportunities globally, but he did, and that individual's come on board, and as I said, taken just under half of that placement. And for us, getting more investor profile in the North American market, I think it's really important, and is going to be a great outcome for all shareholders. We believe that our ultimate acquirer is going to come from that market, and so to get that increased profile is is something that I'm really pleased about, and we'll look to build on as we grow the register and make it more and make our business more appealing to global investors. The final piece I'd like to talk about here in terms of the highlights is the contract award we announced on the 28th of June, and I mentioned a few minutes ago. We've been saying for a while, and it's our customers have been telling us this. Hey, your platform, this is in the energy utility sector. Hey guys, your platform is one day going to become the standard bearer and the gold standard and the must-have for any energy utility in the US in particular that's using digital twin data to manage their network. And if they're not using digital twin data, they're not best practice. And if they're not using your platform, they're not best practice. Well, we've been saying that for some time, and we didn't think it up. Our customers told us this, and what we were pleased to do during the third and fourth quarter of this year was work with the US Department of Energy to establish a program whereby we're going to work with 3 utilities in the northeast of the country to take our existing solution, so no R&D, take our existing solution, apply it to some sample data from their network, and then have some independent, really high-profile universities fact check effectively or verify that we do what we said we were going to do. And importantly, out of that exercise, whilst the revenue is fantastic, the ultimate prize is getting the US Department of Energy to promote our platform and our solution as best practice. And that's best practice in terms of resilience activities. Resilience activities, quite simply, the investment, and it's measured, as I mentioned earlier, it's measured in the hundreds of billions of dollars, and it's got a 10 to 20 year investment cycle outlook, and it's all about the energy utility networks in the US investing in rebuilding and strengthening their networks as they've deteriorated over time, and they've also been more recently challenged by the introduction of residential solar and batteries and electric vehicles, and then intermittent generation from solar and wind. And so the traditional electric network, which had a coal-fired power station at one end, transmission distribution network to the home and business that's been established for more than 100 years, that model's been turned upside down through underinvestment and plain old degradation of those assets, but also more recently this renewables focus, and that means that the energy utilities globally have to invest. I guess it would be measured in trillions of dollars, and Australia's not immune to make the network more resilient to the effects of climate change, but also to reshape the network through the challenges of the renewables revolution that we're all seeing. So I thought I'd jump in and provide a quick update by sector, because we are very sector driven. And survey mapping was when we came out of the gates with customers back in 2017, some of whom, or most of whom, are still customers. I think our very first and longest serving customer is a really high aspiring survey business in Perth, Western Australia, and they've been with us since 2017. And so in terms of the geospatial sector and the digital twin data and the remote sensing data I mentioned earlier, it's this sector, surveying and mapping, that generate the data. And so it's getting those guys on board as customers was our first focus, and indeed the focus for a lot of the early plans for our business. But what we soon realised was that the asset owners were actually more important in terms of financially important for the business because of the size of the contract opportunity. So whilst a lot of our survey mapping customers are paying us $500 or $1,000 or $2,000 or $5,000 US a month, we've got customers in sectors we'll come to later where the financial contributions measured in the hundreds of thousands and in some cases millions of dollars per annum. But the survey mapping sector is important, and what we're seeing now is our platform is maturing and becoming really well known in this sector, that the hardware people, the hardware manufacturers that sell the sensors that get put on planes and drones and what have you, are increasingly coming to us and saying, hey, we'd like to sell more sensors. That's our business. We've got this desktop software that's aligned to the sensor, but you know what? Our customers are struggling to process the data and interpret the data. And quite frankly, if we're able to help them do that, they'd buy more hardware sensors from us. So people like Emerson with their world-class hover map solution, and some larger global aerial LiDAR manufacturers have started to, we've been having conversations with them for a couple of years now, but what we're getting to the point now where these people are lining up saying, hey, we'd like to execute a partnership agreement with you. We'd like to bundle Pointerra with what we sell and ultimately become resellers for us, which is for us it's a great validation from a survey mapping sector perspective, but importantly it gives us scale without adding cost to our BD effort. The next sector that that I'd like to just give an overview of is the power and water utilities space, and really it's about power utilities. During the quarter, we're working with our existing Australian and US energy and South American and European customers across a range of initiatives, whether it's vegetation management, whether it's resilience program investment, and that's from power station through to transmission network through to distribution network. So across the entire life cycle and asset class of these utilities. We've continued to invest from a product perspective. We've continued to invest in BD and sales and trying to find the right people to sell our platform into that sector, and increasingly being more agile with the reselling opportunities and the sorts of the consulting businesses, whether they are your traditional consultants or industry aligned consultants who are undertaking digital transformation activities for customers in their segment, in their sectors. For us is a great opportunity again to work with those guys. They're at the coalface with the customer. They're trying to bring digital transformation tools into those businesses. Important to highlight and reiterate for people newer to the business that particularly in this utility space, so power, water, road and rail, a lot of the businesses, even the privately owned ones, or certainly the privately owned ones, their revenue is regulated. So these are critical infrastructure assets. And regardless of what country you're in, it's rare that the revenue that they can generate from those assets isn't regulated in some way. So if you've got a regulator, an economic regulator saying, hey, this is how much you can charge per dollar invested or per linear mile of track or what have you, then if you're a public company, you're sure as hell looking for ways to rip cost out of your business so that you can grow shareholder returns. So just like us, some of our multi-billion-dollar energy utilities companies report quarterly to the street. We've got we've got Fortune 500 US energy utility companies as customers, and they have to report quarterly. They're trying to grow earnings, and the principal way they can grow earnings is by reducing their O&M expenditure, operations and maintenance, and the only way to do that in any meaningful way, given that all the low-hanging fruit's been ripped out over the last 20, 30 years since they've been privatized, is to innovate. And so I mentioned before structural tailwinds. this drive to innovate, this digital transformation strategy that's happening across the different asset owner classes, road, rail, power, water, mining, oil and gas, etc. The drive to innovate and adopt digital transformation strategies means that you actually need, the strategy means that you need to adopt, you need to deploy digital twin tools. And so we're really excited about how just how big the opportunity is, how big the total addressable market is across the different sectors. And so for us, we need to be laser focused on preserving capital, growing revenue, doing what we said we were going to do, ultimately funding our own growth. But so the issue for us isn't product market fit. It's not how big's the total addressable market. It's about sales execution. And those of you who've heard me bang on about our business before, you will have heard that. I guess that sentiment. The success we've had in the energy utility sector has underpinned much of what we've done over the past few years. And the opportunity now is to parlay that into the other sectors and take the experiences we've learned in working with customers in each sector to take the platform, build out the analytics deck, build out the business intelligence deck, and end up with the complete Pointerra solution for that sector. And certainly in fiscal 24, whilst the financial contribution wasn't massive, the product, the steps we've made in mining, oil and gas, from a product perspective and a solution perspective has been immense. And a lot of the growth that we expect in FY25, whilst most of it's still going to come from the energy utility sector, we see mining, oil and gas as being a really emerging sector for us, with existing tier one customers where we're deployed at a mine site or on a single oil and gas facility. But the opportunity is to deploy across the enterprise and move from supporting operations at a discrete site into being the standard for digital twin platforms across that organisation, meaning anywhere from a dozen to as many as 50 sites, depending on the type of customer, and that ultimately generates opportunities for ARR of well north of $2 to $3 million US per annum. I guess during the quarter and earlier in the year, we announced that we'd struck an agreement with a Middle East-based systems integrator. So again, one of those partnership opportunities where we can access the significant opportunities particularly in the oil and gas space, but also the energy space in the Middle East region, without having to have boots on the ground there. In a formal sense, and working with a trusted partner who's a leader in that market in systems integration and digital transformation. So across oil and gas and mining, it's a positive contribution and growth during the quarter and the year, but I think an even bigger outlook for us into FY25, 26 and beyond. The one of the hardest sectors to crack is architecture, engineering, construction, and ultimately operation. These sorts of customers by profile represent our largest user numbers, where we've got a global engineering firm who's got hundreds of daily users in our platform. And these engineers and digital engineers are often working with workflows, desktop workflows around desktop software applications that have been established over the last 5, 10, 15 years. So we're really fighting to change behavior, and the opportunity to grow in this space and the results we've had in this space during the quarter, but also in the year, have come through identifying champions in those businesses, people who are charged with driving digital transformation, and ultimately helping people see that those desktop workflows that they've become sort of wedded to, that there is a better way. That if you let a platform like ours do the heavy lifting, then you can grow you can actually grow the earnings and rip cost out of your business, but more importantly, deliver your project on time and on budget, shrink program, and most of the blowouts we see. And we're seeing a lot of it in Australia in the building and in the civil infrastructure space. Managing program is the hardest thing. I mean, we've had an inflationary environment, and there's been shortage of materials and people, and that's led to significant blowouts in cost and program. And a platform like ours is a game changer once deployed across the enterprise in helping shrink workflow, bring back program, and get better results for customers. So that's, I guess, Mark, that's as far as I wanted to go with the with the update today. So I know I've only got a few minutes and I've talked for too long. So do you want to throw the questions at me?
Yeah, look, I think we've kind of got 3 questions in here, but they can all be kind of condensed into one.
Yep.
You've talked a lot about ARR, but it's not something you kind of report on a quarterly basis at this stage. So kind of people are wondering, while the revenue is going up and the jaws are going in the right direction, kind of people are wondering when you're going to start reporting that on a regular basis, so people can kind of track these new wins, the Department of Engineering contracts starting to flow through on a revenue basis. So maybe just touch on that quickly.
Sure. So with our quarterly annual revenue and cash flow historically and presently dominated by in terms of absolute numbers by a relatively small number of customers, and with those customers, particularly the US energy utility customers, spending with us on a programmatic basis. We use the word program a lot in our business because these are things they have to do every year, except for last year. And so our longest standing customer, the big energy utility down in Florida, we've been working with them since 2020, and we're doing the same, but more with them every year, and even they didn't pause last year like some of their peer utilities did in terms of their investment in digital twin data and the need to have it interpreted. So what the point I'm trying to make is that these they're programs, and we get them each year, and we've come to rely on them, but it's not pure SaaS yet. And so that's the dilemma. So if we rolled them all in, we'd have an ARR number that I think people would be really happy with. But we're trying to be disciplined about building that ARR number, and we don't want to put it out too early and have to exclude these big customers who work with us on a repeat annual programmatic basis. We're working really hard with them, and with our largest customer in particular, to move them to a multi-year SaaS commitment, and that will have a significant and an outsized material impact on the ARR we support. So I can tell you it's as frustrating for us as I'm sure it is for the investment community to want to track ARR and understand where we're at. And as soon as we're able to, and reliably, then we're going to stick that out there. I think for FY25, the important message and the theme came through in the quarterly, I hope, is that our forecast, our internal budget, and obviously we don't have forecasts in the market, but our internal budget, and it's not dissimilar to what some of the external research, like Research as a Service, has put out there for FY25. We've got a large amount of that in hand. Recent contract awards, customer renewals meant that we, for the first time, we enter the new fiscal year, and obviously we're a month and a couple of days into it, with a large, with a significant proportion of our FY25 outlook already on the books, and just needing to be turned into revenue and cash. So it's the best place that we've ever been financially in terms of the outlook for a year, so early in that year. And so if I can give people, if I can portray that confidence to the market, and then let them know that as soon as we're able to reliably, and particularly this one customer in particular, is being able to include them in the ARR number will I think have the desired result.
And then we've got I'll get one more in here, Ian, if you've got
Yep.
time.
Yes.
Okay, maybe we'll squeeze 2 in. Can you please describe the most novel innovation that has been built as a direct result of having a close working relationship with, it says Lighthouse customers. I'm not familiar, Ian, maybe.
Lighthouse customers. So a lighthouse customer is I guess is a phrase it's the one that you want to put up on and talk about, put up on a pedestal and say, hey, it's a tier one mining company, it's a tier one oil and gas company, it's a $100 billion US market cap US energy utility. So I think the thing we're proudest of, whilst it hasn't had the most significant financial impact, was with that utility down in Florida when the hurricane came through in 2022. And really destroyed a decent part of the Florida energy utility network, as well as obviously a whole bunch of other assets and infrastructure in people's houses. Was that we were operationalized by that customer. So this is 2 years ago. So we're in the third storm season now with that customer. They trusted us enough to operationalize our platform, build it into their emergency response plan. So when a storm goes through, the eyes of the country, eyes of the state are on the utility. How quickly we get people's power back on, because without power, everything else is really challenging. So for that customer to have the faith in us to say, hey, come in, be part of our emergency response. We're going to rely on you guys to tell us where we need to send the trucks to fix the stuff that's broken, because you're giving us insight and a level of detail and accuracy that we've never had before. I mean, that's the best thing we've ever done in terms of the level of trust. I mean, we're trusted by our customers to host their extremely valuable digital twin data. A lot of it's critical infrastructure assets, so it's a big step to give us terabytes and petabytes of data in the first instance, but then to rely on you to actually support something that's got the eyes of the world on the, how's this utility going to perform post-storm? Yeah, that was a great moment for us.
Okay, and then another one. What do you believe has been the main cause of the delays in the Amazon program?
Yeah, Amazon, we announced that contract in January of last year, so it's coming up 18 months now, and we went off with a real sprint with the first 20 or so warehouses. There's upwards of 700 warehouses to digitize as part of Amazon's preparation for having driverless trucks and other driverless cars inside their warehouse sites. So Amazon's gone, like a lot of other tech businesses the last couple of years, has gone through a number of restructures, and so the program keeps getting pushed back. I think it's the best thing to say, the best way to describe it. It's a program we expect to be involved in for many years. It's an ARR that's going to be measured in seven figures. And I think I said in the last quarterly, we thought we'd have revenue and cash in FY24. Well, that didn't happen. So, but the customers, the customer assures us that the program isn't going away. They just need to line up some of the priorities on their side of the ledger, and then we'll be back in there and flying with them.
Okay, Ian, we'll leave it there. Thank you very much for coming back and joining us once again.
Pleasure, Mark. Appreciate the opportunity.
And for getting up early there on your side. Well, not too early over in W.
All good, mate. All good.
Thank you. And thanks to everyone for joining us this morning. And I'll wish everybody a good Friday and a good weekend. Thank you.